All right, I believe that we are live. So, welcome back to my channel. Um, I just wanted to mention I haven't been uploading as frequently as before because I got sick. It wasn't the coronavirus because I am fully vaccinated, but still, I didn't think you wanted to hear all my coughing and all that stuff. So, anyways, we are back on track. And the question that we're dealing with today is something that might puzzle some people. And what's been happening is that companies, in light of the tight labor market, have in fact been increasing their hourly rate. They've increased the amount of wages that are being paid by paid to their salaried workers. And what we're reading in the data is that in fact, despite all of this, workers are actually able to buy less. The actual the real wages have actually gone down. So we're going to look into the question of why that's happening. We're going to crunch the numbers, and I'm going to share with you my final thoughts and takeaways. Right. Um, so let's get into it. Okay. So let's start with this headline um, that's been out there. This is an article from CNN, and as you know, my channel is about unwinding the some of the clickbait headlines that are in the news and giving you proper context, about the economic data, so that it's less of a clickbait. It's less about inciting, kind of panic view about the economy, and a more sober look about, what the numbers actually mean. So they're talking about key inflation measure hits new record high yet again, right? And so if you think back to some of my earlier broadcasts, when I talked about inflation, I said that yes, it's going up, but it's not as much a concern as most of the mainstream media is making out. And so um, you might read this, this headline and think, hey, you know what? What's going on here? This is a little bit alarming. So let's break that down. Okay. All right. So what they're really talking about is the producer price index. I'm sorry, the producer price inflation, and this is the what U.S. producers are able to charge for their goods and services, and it rose 7.8% over the 12 months ended in July. That was certainly more than economists had expected, and alarmingly, it marked a new record high since the Bureau of Labor Statistics began calculating the index in November 2010. So again, that sounds pretty alarming, right? It sounds like, okay, are we pushing into a threshold where inflation really is a serious problem, right? And to go on, so the supply demand mismatch in the pandemic economy continues. Yet on Wednesday, another report showed the roaring surge in consumer prices began to subside in July. You know, it's it's holding at a 13-year high over the past 12-month period, and so you've got this of conflicting signals in the economy. And I know that most people on the public are not, well, they're going to kind of scratch their head and say, what are we supposed to make of this, right? So what's really happening is that, these indexes are different measures of price movement in the economy, right? And so they give you different looks, right? Different looks, and because of that, because they're measuring something slightly different from one from the other, it's not surprising that the numbers vary. Um, but the thing that really that you should note as a member of the public is that when economists have looked at the consumer price increases, right, and we set aside the price increases that are due to the pandemic, and because of the supply chain constraints that have happened, right? We start to notice that it's not so much the case that the prices are going down, but the amount of increases are starting to moderate, right? So a lot of the volatility in the consumer price index is starting to subside, and that's been a little bit of reassuring number, right? But this headline is making a big deal out of the fact that the U.S. producer price index has gone up by quite a bit, right? So that's certainly noteworthy. Every data is valid, but again, you need to balance out with that with everything else that's happening. And the overall indication is that yes, uh, consumer price indexes are continuing to increase, but the intensity, the heat of those price rises are starting to cool down, right? So, getting back to the topic at hand, though, what does that have to do with the fact that workers are actually being paid less, even though they're being paid more, right? So let's get into that. And basically, what it's really trying to say in this headline is that inflation is what has wiped out the pay raises for many of the workers that are out there, right? So the idea is quite simple. Yes, companies are paying me more, but the prices of the stuff that I buy is now higher. Gas is higher, food cost is higher, certainly car prices are higher. That's a persistent problem um, during this post-pandemic recovery, right? So yeah, that's a simple concept to grasp, right? But we need to consider that in the proper context, in the sense that is this actually a problem? Well, yes, it's a problem because right now the pay increases are not keeping pace with the price increases. But as I said a number of times in my previous discussions about inflation, right? The real question is how long does it last, right? I mean, is it a temporary problem or is it a long-term enduring problem? So in that sense, the recent data that we have seen, doesn't really change the fundamental policy question that's faced by the Federal Reserve, right? It's a question uh, of um, of temporal duration, right? How long does it last? Is it temporary? Is it permanent, right? If it's permanent, then that requires a monetary response or some action by Congress. But anyway, so that's the idea, right? And so, um, in this current time, compensation rose 2.8% between March and June, despite the relatively high unemployment rate. Now, we've talked many times before about the tight labor market, but there's also a high unemployment rate, basically meaning that so much of the jobs that we lost in the pandemic have not been fully recovered. I think we're still at maybe, I'm thinking 6 million jobs that have not been recovered from the pre-pandemic era, right? So this is the weird thing that's happening right now in the economy when we talk about the labor market, which is that despite the fact that we have a lot of lost jobs and the unemployment rate is high, compensation is going up, right? Before, in normal times, if unemployment is high and people are having a hard time finding jobs, that means pay actually is going down, but in fact it's going up, right? So that kind of gives you an indication of how things are a little bit topsy turvy right now in this economy, right? And as I mentioned in the previous live stream about the labor market, job openings are at record levels. I think over 9.5 million, if I remember correctly. That's from the Bureau of Labor Statistics, right? Um, and so there was a study by Jason Furman, an economist at Harvard University. And it's an interesting study. I mean, conceptually, it's not a huge reach. Basically, he is netting out inflation from the wage increases. And so he looked at the employment cost index. That measures wages and salaries along with health, retirement, and other benefits. Fell in the last quarter and is 2% below its pre-pandemic trend. When you take inflation into account, okay, that's when you adjust the wage increases and then deduct the inflation, right? And does note that wages and salaries are growing at a faster pace than benefits, right? So, you've seen this chart before in, again, one of my previous live streams about the labor market. This is average hourly earnings by industry, and you can see the percentage increases are really quite substantial, especially transportation and housing, leisure and hospitality. And in fact, in the previous study, that was done by um, Professor Furman, right? He did note that overall, because of inflation, real wages uh, for the public in general has gone down, but for example, for leisure and hospitality, because the wage increases were so much, right? Um, they actually did experience an overall increase in wages even after netting out inflation, right? So, well, that's one point to consider, right? Whether the inflation has wiped out your wage gains really depends a lot upon the industry where you work, right? So if you're in a particular industry where, for example, like transportation, housing, right? You might still be doing fine, right? Because the companies are paying you so much more than before. Um, so that's really what the major policy question that I mentioned a few streams ago with regards to inflation. I think I talked about it in my first inflation live stream, which basically said, okay, and reading from this quote, to the extent that inflation is transitory, this dip in real wages is also transitory. So it's from Tim Dewey, chief U.S. economist at SGH Macro Advisors. Okay, so this economist is making the correct point that, of course, right, the policy question faced by the Feds, as I said just now, it really comes down to, again, whether the transitory nature of inflation, right? So no one is contesting the fact that prices have gone up, right? No one's saying that, and certainly not in any of my videos. But we are talking about whether the concern that we see in mainstream media is warranted, is proportional, right, to some of the hysteria that's out there, especially about all the talk about hyperinflation, right? When our overall consensus is that inflation uh, increases are transitory due to supply chain constraints caused by the pandemic, right? So, but I mean, is that really the only lesson to be learned here, right? The fact that inflation has wiped out some of the wage gains, and that's it. No, actually, there's a deeper point that needs to be made, and it's something that I emphasize whenever I talk about wages and real wages and so on and so forth. And I'm going to show you a couple of graphs that I've shown before, and I think this is a really super important message to get out to the public. Okay, so going back to the screen. Um, First, take a look at average hourly earnings, right? So um, it's obvious to see when the pandemic happened, this massive spike, uh, um, you know, um, of earnings going down, and then the very rapid recovery, right? So, um, well, we're talking about the post-pandemic recovery. We're talking about nominal wages, right? By nominal, I'm talking about wages that are not adjusted for inflation are actually spiking upwards. And you might think, well, okay, despite the inflation, which I personally expect to be a temporary issue, right? Once that happens, right, this rapid recovery in in wages should benefit people for the long term, right? And let me see. Yeah, so this is a chart that I like to put forth to people all the time, right? This is super important to make whenever we're talking about salary and real wages. And you've seen this before in my earlier broadcast, which is this is the so what are we looking at? There's panel A, the panel B, men versus women, and this is the cumulative change in real weekly earnings of working age adults, uh, 18 to 64, from the years 1963 to 2017, right? And to explain the gist of um, this chart, it basically breaks down, um, you know, uh, what happened to your pay over the period of 1963 to 2017 based on your level of education. If you have a high school degree, you've had a rough, or you were a high school dropout, you had a rough time, especially if you're a man. Obviously for women, same too. You know, um, and it's corresponding always to the level of education that you've had. And of course, if you have a graduate degree, you've done very well, even in this pandemic economy, right? And so that's something that I really like to emphasize uh, in my live streams. If you're worried about the future, if you're worried about job security, if you're worried about, the long-term uh, growth in your wages, right? The best thing that you can do for yourself is to uh, get an advanced degree. Now, I know that's a difficult question for many people in this economy. Not everyone has the opportunity to pursue an advanced degree, but as an economist, I have to lay out the realities of what's happening out there, right? Education means earning power, period. Okay, and that's pretty much it, right? So, so that's the I think the key takeaway from all this talk about how inflation has wiped out, uh, your wage increases, right? And I noted that in certain industries, right, the wage increase had been so much that even the relatively sharp increases in inflation have not wiped out the gains, but even more, even more important and deeper point to consider is that if you have a college degree, or even better, advanced degree, a master's degree, a PhD, uh, you're going to do fine, irrespective of the inflation that's happening in this economy right now, right? So again, recognizing that not everyone has this opportunity to to pursue higher levels of education, I want to convey to you that's the reality of our economy right now. The importance of education and knowing information technology, computers, programming, and now we're getting into machine learning and AI and all that kind of stuff. So that's the key takeaway. Okay, don't let the headlines scare you. Understand the reality of the economy, which is basically this chart right here, right? And take what actions you can to protect yourself against any danger or future risk of inflation. So, anyways, I hope you found that useful. And like I said, I stream on Wednesday nights and Sundays. And I hope to see you at the next video.